Standard costing is actually a really simple concept and pretty easy to do, so don't be afraid. You can land on the bird feeder and rest comfortably once you're done with the video. Now, I do this a little differently than any book, but it's way easier. You'll always get the same answer. However, if your professor has you show your work and gives you partial credit for doing things correctly, you might want to show him or her the examples here and make sure if you do it this way, you'll get the maximum credit. If not, you can always use this to check your answers because again, you'll always get exactly the same solution. So let's get started. The first thing we need to talk about is the difference between a master budget and a flexible budget. The master budget's what you do at the end of the fiscal year to plan for the next fiscal year. So usually the date on that will be December 31st or January 1, and it's what's your best guess at the beginning of the year. So you need for planning to have an idea of what you'll do in the next year, so you'll have enough cash and that sort of thing. But you really don't know until you work through the year exactly what your production and sales are going to be. So a flexible budget takes those same relationships you use for your master budget. If you think about it, your master budget's just a spreadsheet, so you can change some of the variables and get a flexible budget. So it's those same relationships with any other volume other than what you thought you'd do at the beginning of the year. Normally the thing you care about most are actual units. So normally it's actual units, but it could be as you go through your months, your monthly production clearly will change, and you can update or change your master budget monthly, and that would be called a flexible budget. The importance of the flexible budget is the master budget makes a lot of sense when you're planning, but makes no sense when you're evaluating people. So the reason is, if you think about it, would you expect your total variable cost to match your master budget if the actual units change? And hopefully you're screaming out the words, no way, because the whole idea of variable costs are as as units change, variable costs change as well. So you know by definition, because it's a variable cost, you would not expect the cost to stay the same when units change. Would you expect total fixed costs, however, to match the master budget? Hopefully there you're yelling out the word yes, because what makes them fixed is regardless of the units, as long as you're in the relevant range, those fixed costs stay the same. So you would expect somebody who's spending fixed cost to stay within that master budget level. Lastly, would you expect allocated fixed costs to match the budget? And in some books they call it applied, and some they call it allocated. I'm going to use allocated, but if you learned applied, just substitute that word. The allocated fixed costs, thinking back to those job order chapters, occur because we take a rate, and every time we manufacture a unit, we take that fixed factory overhead rate and add that to work in process. So our allocated fixed costs are that rate times actual units. So if our actual units don't equal the master budget, again, by definition, our allocated will not match the master budget. So the answer there is no. So thinking about it, you've got to do your variable costs differently from your fixed costs, but all the variable costs kind of act the same, and the fixed costs are the same as well. So I'm going to come up with a model that will help you do variable costs one way and fixed costs another. We need an example. So here I'm going to manufacture these handmade lawn ornaments. There's not too much in materials costs, but they are very highly labor intensive. So you estimate it costs 50 cents per pound for the materials, in this case metal, and each unit uses 4 pounds. So that's kind of a heavy owl, but it makes it work. At the beginning of the year, you anticipate making 2,500 units. What's your master budget for the materials used? Hopefully I gave you time to calculate. 2,500 units times 4 pounds times 50 cents. Your master budget is $5,000. At year end, we actually spent $4,200 on materials. So is that good news or bad news? Well, you first might look at that and say, well, we spent $42,000, we thought we'd spend $5,000. We did really well. But you really can't come to that conclusion so quickly because it depends. If I only manufactured 1,000 units, then I'm in really bad shape. If I manufactured 6,000 units, I'm in really good shape. So you really don't know until you know how many units you actually manufactured. To determine if it's good news or bad news, you need to know what you actually produced. So let's say you made 2,000 units. Now you can determine, is that good news or bad news? We should have spent $4,000. Looking at the information, 2,000 units at 4 pounds and 50 cents per pound is $4,000. We spent $4,200. Therefore, it's bad news. The next question is, who do we yell at? We need to figure out who bought the stuff, and they should have paid 50 cents per pound. We spent 56 cents, so the purchasing department spent too much. Then you worry about the production department. They should have used 8,000 pounds, 2,000 units at 4 pounds each. They really used 7,500 pounds, so that's good. They worked more efficiently than we expected. So the production department should get a pat on the back. We want to come up with a format then to do that analysis that we can use for all the variable costs. The thing to remember is you always compare to the actual number of units, not the master budget, because we know that for variable costs, the costs will change based on units produced. The other thing is we want to change one thing at a time, so we'll know who to go congratulate and who is in trouble. So we need to determine if something happens because of price changes or because of efficiencies. The basic table we're going to use is going to set up the quantity in one column and the price in the other. The way I remember that is it's QP. So if you're old enough to remember a Cupid doll, the Q's come first and the P's come second. You can come up with your own way to remember it if you need to. Then we start with the actuals always. So actual times actual would be the actual cost. And then we just want to change one thing at a time. So we want to just change the price. And I can't find my cursor. There it is. All right. We want to just change the price there to standard. So we'll tell from the difference for the first two columns what the price impact was. And then for the last row, we want to just change the quantity from actual to standard. So we're changing one thing at a time so that we can isolate the issues. When you set it up then, I'm going to just generally use the abbreviated table where it's actual, 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 standard, standard, standard. The first row is always actual, last row is always standard. So the only thing you can kind of screw up is that middle row. Different ways to remember it. Make sure you always put your actuals first, The way I do it, if it's actual, standard, 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 if you're from the South and you talk really slowly, it kind of spells a word, and if you want to use that to remember it, that's fine with me. So let's put this all together. This is the same information, including the master budget information. Again, you should know that's not relevant, so don't use it. It's just there to see if it can confuse you. We're going to use that same table. And so the quantity, again, the quantity is related to whatever variance you're doing. So the quantity of materials used. In this case, we used the metal, which was measured in pounds. So it's the quantity in pounds. So I was given that we use 7,500 pounds. And I know I'm going to need that 2 places, so I'm just going to copy that down to the second line as well. My price per pound, my actual price per pound is 56 cents. And so the total's 4,200. Sometimes they'll just give you the actual cost of 4,200, which is fine. Just put that in. You really don't need that actual price per pound to do the variance. Next, we need the standard price per pound. And again, I want to stay in pounds of materials. So I should have spent 50 cents. Notice that goes 2 places, so I'm just going to copy that down there. 7,500 times 50 is 3,750, so I'll figure that out. And then we've got one little space then where I've got to come up with the standard number of pounds I should have used to make 2,000 units. So that's the only number you really have to calculate. Remember, you always want to use the actual number of units. So the 2,000 times the 4 is that 8,000 pounds that we found in the prior slide. That's how much you should have used to do what you did. So the 8,000 times 50, I should have spent $4,000. I really spent 4,200. Subtracting the first 2 gives me 450. That's called the price or the rate. And again, as managerial accountants, we're not too clever. That's the change in the price from the standard. This case, it's unfavorable because we spent 56 cents and we should have only spent 50 cents. So again, that's the purchasing department's issue. We subtract the second 2, and there it's $250 is the difference. But notice that's favorable because we should have used 8,000 pounds. We only used 7,500 pounds. So we worked very efficiently, or we used much less materials. So that's called, depending on your book, either a usage or an efficiency variance. If we look at these 2 together, notice one's favorable and one's unfavorable. If they went in the same direction, we'd add them, and so the one's negative, one's positive. So the net between those 2 is my total materials variance is $200 unfavorable. So before you go, you would generally go yell at the purchasing department for the price, and in this case, give your production department a pat on the back. But if you go talk to purchasing, it's possible that what they tell you is, well, we bought some really high quality materials, and that's why we spent 56 cents. And you see it showed because the production department had a lot less waste, and so they used only 7,500 pounds. And this is where the total comes in, because you'd have to go to the purchasing and said, really good idea, but we still have a $200 unfavorable. So unless you can negotiate that price down a little bit below that 56 cents, you're better off buying the cheap stuff and letting us throw it out. So you do have to look at the overall as well as those individual ones before you go making departments mad at you. The next variable cost we care about are the labor costs. So we'll say the standard to make one owl is 6 hours of direct labor at $15. I give you the master budget again, but that's not used, so don't take the bait. You actually made 2,000 units, worked 12,200 hours with a total cost of $185.60. We want to use the same table with quantity and price as our columns, and then actual, standard, standard, standard. The quantity we care about is hours, because when we're in labor, we measure things in labor hours. That didn't quite sound right, but you know what I mean. The quantity then is 12,200 hours, and we put the actual 2 places, so we fill that in. Normally, you only know the total amount that you paid your laborers, so we know we paid at $185.60, and then if you want to, you can fill in the cost per hour, but that's up to you, and in some problems, they'll give you the rate per hour instead. So next we just need the standard price, which was 15. We know that goes 2 places, so we put that in there, multiply across. So the only hard thing to figure out is that bottom left-hand corner, and that's how many hours should it have taken you to do what you did. So we did 2,000 units. It should take us 6 hours for each one. So the number that goes in there is 12,000. Multiply that across and get 180. Like we did before, then we just want to subtract. So subtract the first 2, and that's your price or your rate variance. Different books call it different things. Subtract the other 2, you get $3,000. That's called usage or efficiency. Again, different books use different things. But that generally is the same name that you use for materials. It's just would be labor instead. The only thing sometimes students struggle with is if it's favorable or unfavorable, and you can kind of look. We actually paid people $14.80. We thought we'd pay them $15, so we got a bargain, so that would be favorable. If you notice in your table, the actuals are always on top and the standards are what's on the bottom when one thing changes. So the easiest way to remember it, and hopefully you can think through it, but every now and then it's nice to just have a memory rule. If the top number's bigger, it's bad. So the 180 is less than the 183, so that's favorable. Whereas the 183, that's the top number, is bigger than the 180, so that's bad, so that's unfavorable. So in this case, our price variance is favorable, our efficiency variance is unfavorable, but they can flip back and forth. That all depends on really what happened in your company. Again, total those up to get the total variance. Since one of these is favorable and one's unfavorable, you need to subtract them because one's basically negative. So the net is a 560 unfavorable variance. Generally, you split this one apart because you really care about that efficiency variance. You often don't have much control over the rates. It depends on what your union contract says, but the efficiency variance really is telling you how efficiently you're using your labor. Well, if you were dozing off, that dog barking should have woken you up and gotten you ready to go again. The next variable cost deals with the variable manufacturing overhead. The good thing is half of this comes directly off the labor table, because in this chapter we will always apply our overhead based on direct labor. So the rate for our variable manufacturing overhead in this problem is $4 per hour, but the number of labor hours to make the owls is the same 6 hours we saw on the direct labor table. The master budgets, again, should be ignored. You actually made 2,000 units. The 12,200 hours actually worked is, again, directly off of your labor. So the only extra information you need to know is that the cost for the variable overhead is $50,630. So we want to fill in the quantity directly from our labor table. So it's 12,200 for the actual, 12,000 for the standard. All we need to do new is put in the 5,630, the actual times actual is your actual. Again, if you want to find the price per hour, that's up to you. The standard is $4. That goes two places. Multiply across, do our subtraction. And again, if the top number is bigger, it's bad. So that first one is unfavorable, and your second one is also unfavorable. The efficiency you kind of knew was going to be unfavorable because that's how inefficient your laborers were. And so if your labor variance is unfavorable, your variable manufacturing will also be unfavorable. So it really just means it costs you even more to work those extra 2 hours, not only just the amount they paid the person, but for all the indirect labor and the other stuff that has to happen to keep people working. Again, total those up and you get the total unfavorable. In general, for the variable manufacturing overhead, what you care about mostly is that price or rate, because again, you already knew about the labor inefficiency in this case. So you want to know if in general you spent too much or used too much of those variable manufacturing overhead items. And often you'll split these where you'd have your indirect labor, you'd have your indirect materials, you'd have all the different components of your manufacturing overhead. Fixed costs are the last ones we want to talk about, and they're different, so you cannot use the table we had before. And the reason is if volume changes from the master budget, what do you expect to happen with fixed? Finally, fixed cost variances are different because if volume changes from the master budget, what do you expect to happen with fixed costs? And the answer is absolutely nothing. The whole thing that makes it fixed is within the relevant range. When the volume changes, the costs don't change. However, how do you allocate overhead to units during the year? If you remember, we came up with that rate, and every time we made a unit, we put that rate into the account. And so we allocate or apply as the units are produced. That means at the end of the year, the total number of units produced times your rate is the total amount that's going to be in that account. So the budget's not expected to change based on production or sales, but the allocated costs do change. Our basic table then for fixed costs, we still have the actuals on top. So the actual costs go on top, the budget goes second, and the allocated, which really is standard at standard, goes on the bottom. So it's really just that middle line that's a little different. As managerial accountants, we're not too creative with titles. So the difference between actual and budget is called a budget variance. The variance because the volume of units changed is called the volume variance. For a little memory tool, I use the phrase a bud for all. I'm from St. Louis, so we know Budweiser. The actual costs, you can say an actual bud for all if you have problems getting the A's straightened. Now we'll use that table for our same problem, manufacturing those metal owls. Our master budget is for 2,500 units, which we've had in all the slides before. What we're adding here is our estimated fixed manufacturing overhead was 50,000. We actually made 2,000. Again, that's consistent with the other parts of this problem, but we do need to know that our actual fixed manufacturing overhead is 51. So you can kind of just look at it and see we estimated 50 and we really spent 51. So it's bad news, but we want to make it a little bit more complicated. So we'll use our table. The actual is normally just given. So our actual is 51,000. I've got the 2,500 spinning because the budget is based on that budgeted volume. And this is the only place you use that 2,500 master budget volume. We know that the estimate for our master budget was 50, and some problems will give you that. but we do need to know what the standard rate is so we can divide that and get the $20. Some problems they'll tell you the $20, some you'll have to solve for it. That $20 then is allocated to each unit as you produce it. So we have, for the allocated, our actual 2,000 units times our $20. So we ended up allocating or applying $40,000 in fixed manufacturing overhead to our inventories. Then we just subtract like we did before. 1,000, that's your budget variance. Unfavorable, can stick to. If the top number's bigger, it's bad. 10,000 is unfavorable for the volume variance. And what you normally really care about is that budget variance, because that's really how much you spent over and above what you thought you should. The volume variance is something you would just know looking at the numbers. Again, we know at least it's unfavorable because we thought we'd produce 2,500. We only did 2,000. So if you don't make as much as you'd hope, that's generally bad news. The other thing that makes that unfavorable is you've been going along thinking, oh, my fixed overhead's only $40,000 and really it's 51, and it really is estimated to be 50. So you want to make sure that you that's unfavorable, because now all of a sudden FASB's going to make you book that extra 11,000 in overhead costs before you do your financials. So you thought everything was going around hunky-dory, and then all of a sudden you get a big hit at the end of the year. Again, total variance, you just add those together, and since they're both unfavorable, you've got $11,000. There's one last twist, and in some classes they do this, and in others they don't. So just kind of, again, see what your professor is going to emphasize. But with materials, especially if you inventory them for a while, you really want to know if purchasing spent too much the minute they purchase them. You don't want to wait 6 months when they start using those materials to find out, whoa, somebody was going crazy in the purchasing department. So sometimes we split out the timing of when we do these variances, and we split them out so we know what's purchased and what's used. Still use the same table, but in this case, again, we're going to say you purchased 10,000 pounds, but we only use 7,500. So we want to do the first 2 lines of the table based on purchases in the month of the purchase. So we did 10,000 at 56. Again, we spent too much. We know that, but we want to know that it's $600 unfavorable, not just based on the 7,500 we used. And so that way, again, we can go talk to the purchasing agent and hear why they're spending too much. And especially in this case, then we can go track production to see if in fact they really are using those materials, those expensive materials, better, or if purchasing just spent too much. The used then is based on the materials used, and that's exactly the same as what we had before. So we have the 7,500, that's the pounds we used. We should have used 8,000, and our standard's 50. So that doesn't change at all. If you go back several slides, you'll see that was our efficiency variance before. So all that changes is you have those first 2 lines you do at the time of purchase rather than when you use it. You don't have that for labor because we pay the labor as they work. So those rates are based on what is used. So this is the materials is the only place you have to worry about that. So that's all there is to it. Practice makes perfect. Again, if this is a great way to check your work if your professor doesn't particularly want you to do a method different than he or she's showing you in the book. But this is way, way easier. So it's safe to land and have dinner like this hummingbird did. It's not all that scary.